Come on in. If you're watching the replay, we can fast forward a couple minutes. We wait for the live studio audience to come in. I'm a 30-year veteran of Wall Street technology and AI research. Retired in 2008, a multimillionaire, earning seven figures a year on the basis of my proprietary stock finding methodology. This is not day trading, my folks. This is information that people like Jim Cramer, his funds, George Soros's funds, and if you watch the movie Dumb Money, if you haven't, go watch it. Stevie Cohen's funds, these are multi-billion-dollar funds, paid me for my picks, real stock picks. And now, because of the good fortune God gave to me, because my mentor put me in a position to become that rich and successful, to have checks signed by Jim Cramer to me, I come back here once a week and give back to society for 2 hours. No sponsorships, no advertisements, none of that BS. Nothing like the 10,000 clowns out there that are trying to convince you that you should listen to them. Why? Why? I'll tell you. I'll tell you exactly what to look for out of those people, so you will know if you're dealing with a professional or one of the 10,000 clowns. There we go. We got audio, we got video confirmed. We got the thumbs ups coming in. We got the veterans coming in. We got our weekly regulars that come in here. I know it's a 2 hour show. I can't watch a 2 hour movie. Excuse me, I'm eating lunch. This is how it is on Friday. Like from the moment I wake up, it's pulling all the information, all the research, all the AI that I gathered during the whole week and figure out how to formulate it perfectly so I can fit it in to a 1 hour speech for y'all to get you up to date on what's happening in the world of tech and AI, and then answer your Q&A for the last hour of the show. All right. And all I ask is that you share the invite to this show with your friends, your family, spread the word so we get a nice big audience over here. And once we get that nice big audience, what you get from me is it's Friday. It's Money Mark and it's Stock Talk Live. We got another big show for y'all this week. If you saw the invite, we're talking about AI as usual. We're talking about technology. We are asking and answering the question, are we in a bubble or are we in blast off mode? Now, of course, I came on here. I've been on here almost 3 years telling you AI is not a bubble. Now, finally, all the clowns out there who were saying AI is a bubble. Crickets. Because these stocks, these technologies, the demand for this has taken off to a level that the industry cannot even keep up with. Okay? I'm looking at a stock like Iron, IREN, right? They have tons and tons of energy assets, and they can't deploy them fast enough. They got 4% of their energy assets deployed. Okay? If they could snap a finger and have 25 times more data centers built out to take advantage of those energy assets, they would, but they can't. Okay? We have shortages out there. We have HBMs that Micron and Samsung and HK Hynix make. Right? I told you Micron at $100. Where is it now? Hundreds of bucks. Right? This is what we do, and it's based on real research done through independent, third-party, industry experts. 99.9% of investors underestimate that. 99.9% of the 10,000 clowns don't use that. And it's the absolute key. How are you going to understand an industry? How are you going to understand the difference between Micron's HBMs and Samsung's HBMs if you don't have an expert who actually, I don't know, call me crazy, made HBMs for a living? For a couple of decades, preferably? Those are the kinds of contacts that I use to find out what's happening next in the technology area, because guess what? I'm not that. I've never worked in a semiconductor fab. I don't know what goes on there, except through the stories given to me by my contacts in the industry, which feeds into my stock picks, which come back to you, which is why I've been able to make 40% a year on average, dating back to 1996. It makes making 7 figures a year easy. Easy. Okay? And you can take advantage of that as well. I give you the rules on how to do that. I make the picks, I give you the information, and some of y'all want to learn how to find the picks. That's cool too. All right. So here's your disclaimer on the screen. If you go any further than this, if you want to go down the rabbit hole with your buddy Money Mark, you read this, have somebody read it to you, acknowledge it, absorb it, and accept it. Okay? Because I'm not a financial advisor. I'm not your financial advisor. This for information only, blah, 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 blah. That takes care of that. All right. As promised, the 10,000 clowns. What do you want to look for? By the way, there's my Twitter. Okay. Here's what you want to look for from the 10,000 clowns. Number one, their real name. Mine's out there. Okay. So you can look them up. Here you go. Real name. Number one. Real background, credentials, okay? Those are my credentials that tell you why I'm qualified to talk to you about technology and AI stocks. Already, these two qualifications, 90+% of the 10,000 clowns out there fail. They're already gone. Now you know not to listen to them, okay? I'm not saying I'm the only one. I'm just telling you how to get rid of the 10,000 clowns out there trying to give you random picks that are going to make you money. Guess what? Any monkey can pick good stocks when the market's going up. Duh. So why should you be jumping on some clown's picks who doesn't really know what they're doing? They're just throwing darts at the board and you're hoping that you're going to hit the bullseye? No, that's not how you get rich. If it was, everybody would already be rich. Common sense. All right. So real name, real credentials, and then what I got here, a real-time tracker going back to 2014 of my picks. These are called ideas. My ideas, let's not call them picks. We don't want anybody to misconstrue anything here. And what you're going to see on this list of picks is that, boom, going back to May, nearly 2 years ago, I have not closed out a single position at a loss. Not one position closed out at a loss. This is a real-time tracker, okay? The 10,000 clowns will try to fight it. Say, no, Mark, shut the F up. This is live. There's live people in here right now. If I make a single change to this spreadsheet, there are literally thousands of people that see the change in real time. So if what you were saying was true, which is not, there'd be hundreds of other people backing it up, and they're not. Why? Because you're one of the 10,000 clowns. Okay? That's how we work here. Only one negative name on the list. We're working on it. We're not closing it out. There's lots of value in this name. We'll talk about it later. Okay? So real name, real credentials, and real-time tracker of what they do. By the way, before 2014, before I started tracking that online, right, we had this. This was right on the onset. Right before I started real-time tracking, there was tracking going on Seeking Alpha. All of the articles that I did when I was writing for Seeking Alpha. 5 years, 24 triples. Documented, okay? Unlike the 10,000 clowns. I'm not trying to pat myself on the back. I'm telling you, this is what look, if you're listening to me, then I should be the minimum. Anybody you listen to out there should be at least as good, right? And if you strive to find people at least as good as I am at this, then you're going to be dealing with the best of the best of the best. And forget about the rest because they're wasting your time, and time is money. All right, there's my speech for this week. Let's get into the show. As always, we start with a very quick macro. What's going on with the stock market? All-time highs, all right? But What do I care about more than all-time highs? Cares about all-time highs. We care about valuation, because valuation helps you to calculate risk reward. Okay? Technical analysis, momentum, sentiment might tell you where stocks are going next. Well, let me tell you something about all that. All those people that follow charts and all that stuff, most of them go broke every time there's a crash. And guess what? Every time there is a crash, there is a next crash coming. Is it coming tomorrow? I don't know. I'm not God. And guess what? Nobody else you're listening to is either. So it's imperative to make major money during the ups and then know when to protect your money, and valuation tells you when. Do you know how many? Oh, you want to see something crazy? Watch this. You ready? Nvidia. Told y'all to buy it at 42. I sold it at 142. It's now 200. Okay? Mark, you missed out. I told you to buy ARM very recently. Look at this chart. At the bottom of this chart line, okay? I didn't tell you to buy ARM. It's a figure of speech. So, anybody watching, if I say a pick or I told you to buy, it's a figure of speech. At the bottom line, $100, 233. Money Mark, your buddy Money Mark got out at 170 thereabouts. What a loser. Money Mark, you're a loser. You sell too early. You sell too early. You sell too early. You sell too early. See, this is the difference between a pump and a real stock analyst. Okay? When you look at a Kraken that I got you in at 70 cents when nobody knew what Kraken was. They thought it was crypto. And it tripled. And it reached the highest level that I was capable of feeling comfortable with, because I didn't have any more data to calculate that the risk reward was appropriate at those levels. Did you hear that? I was very careful about those words. My capability reached its limit in terms of understanding this company enough to go further than $2 per share. It's now almost $6. You know what a pump would do? They would pump. And they would dump. There's no pump and dump here. These are real companies. These are real companies that will continue to perform well into the future most of the time. I just decide to get out when the risk reward reaches a level that's inappropriate for me, because I want the low-hanging fruit. I like the quick triple. If I find a company that can go up 5x and it goes up 3x, guess what? I'm taking some money off the table. That's the low-hanging fruit. And moving on to another company that can move up 5x or 10x. Because that's all I spend my days doing. I don't waste my time trying to figure out if a $200 stock can go to 210. You can't triple your money in that situation. And neither can you. I can't. You know what I'm saying? All right. There goes my lunch. Anyways, Fear Greed Index hit 71, very close to 75, so that's dangerous. The Russell 2000, yellow alert territory. If you don't know what that is, then you haven't watched my introductory video, which is here. It's on this YouTube page somewhere. Boom. I got to find that, actually. This article on my website, markohmstocks.wordpress.com, not highly active, but this article right here will tell you a lot. And then if you go to my Twitter page, pinned to the top is a recording on how I find multi-baggers. All free, no sponsorships, no advertisement, not trying to trick you in or anything. I just put these resources out there for my friends and family. And guess what? If you're here, you are considered one of my friends too. So either you grab a notebook and a pen and come into the classroom known as Coach A-Hole's classroom, Money Mark, aka Coach A-Hole, or you don't. I don't care. I don't care if you become rich. I'm already rich. You becoming rich does not make me more rich. You becoming rich actually makes me less rich, because if everybody was a multimillionaire, then nobody would be rich. That's called relativity. Anyways, Interest rates still elevated from where they were a couple months ago. The Iran situation, blah, blah, blah. Inflation, blah, blah, blah. Unemployment, blah, blah, blah. The economy, blah, blah, blah. Guess what? I'm not saying it's not important. It is. But how do you or me or anybody else know how to take all those millions of things happening in the world all at once and figure out what it means for the stock market? You can't. Only God can. There is nobody known for that. Nobody. Think about it. Nobody is known for that. Warren Buffett's known for buying and holding forever. Okay? Nobody is known for that. But one thing that can help you more than anything is watching that sentiment. And when the sentiment gets high, right, where you have fear, greed getting into greed territory, 75 being the point at which I'm like, all right, that's the danger. That's the red line. We got to 71. Very close. These lines on the chart going back decades. Okay? In the case of the Dow, literally over 100 years. You want to see? 1915 is where this chart goes back to. And it shows you S&P 500, where we stand on a long-term relative basis. There's the Qs. And on the Qs, the only time the market was higher was during the internet bubble. Now, here's the trick. Because AI, in my entire career, this is the first time I've seen something since the internet bubble that reminds me of the internet bubble. This is the first time that I said the market could go above the yellow alert level and keep going for a while. And if you see here what actually happened during the internet bubble, we hit a yellow alert, okay, long before the internet bubble burst. Same with the S&P 500. Okay, the S&P 500 went into yellow alert territory as early as 1997. The Fed chairman at that time, Alan Greenspan, said that there was irrational exuberance in the market. Well, that irrational exuberance continued for a few years. But guess what? If you had gone into yellow alert mode and followed the yellow alert rules at this time, you got to buy stocks at a lower price a few years after that. You made more money. I know because I did. And in fact, when the market finally did crack, I knew when you break above these lines, you don't break above these lines. These lines are made out of rubber. It's a stretch. If you stretch rubber, what happens? The more you stretch it, the more it snaps back. And that's what happened. The market tanked. You know what happened to Micron back then? Take a look. Micron almost hit 100 in 2000. You know where it bottomed out? One. It went from 100 to 1. And I'm going to tell you why you got to be careful with Micron now. In fact, I'll tell you now. Might as well, right? Enough speeches. Let's get into some stocks. Because you now know that we're in yellow alert. You now know that the fear greed is at an elevated level. So you know that you need to follow the yellow alert rules, which I talk about every week. So I'm not going to talk about them again today. If you're new to the show, go watch the old shows or go watch those educational materials that I showed you just a few minutes ago. It's up to you. All right? I'm not going to waste everybody else's time. So Micron, let's talk about it. I gave it to you at 100. Thank you, KC. You know who you are. One of my industry channel experts, multi-decade expert in the industry, gave us the heads up that pricing was going to go up dramatically in just a few months. Several months ago, when the stock was still $100, it's now almost 500. That's a 5-bagger for a company this big in just a few months. That's the power of having independent third-party industry experts on your side. Real research. Now, what everybody's saying is, yo, the
The demand is off the charts. It's going to continue off the charts. There's no more capacity. Capacity isn't coming online until late 2020. Yes, I know. And so do you. And so does everybody else. That's why the stock went from 100 to 500, stupid. And now it's here. Now the stock has reached a level that is, from a long-term perspective, just about as high as it's ever been. It's reaching levels that only match the internet bubble back in 2000. So can it go a little higher? Yes. You see, you've got room for, we can make a little more money on this. But you could also crash, okay? It wouldn't take much from these levels. And that's the thing you got to be careful of. That's why I'm out of Micron. Okay? I love the position of Micron right now. The fundamental positioning of Micron is incredible. But there's a difference between a fundamental positioning and what you pay for it. And right now, the positioning is no different than the excitement I had several months ago when the stock was $100, except now it's 500. If I like a house that's $5 million and then the price goes up to 25 million, guess what? I'm going to like that house a little bit less, unless it's already mine. And if it is, I might sell it to somebody. Okay? Same deal goes here. You have to be careful. And here's the thing that really will teach you how to differentiate winners and losers when it comes to this. Micron, number one, they're not even the best in the space. Okay? There's three major players in the space: Samsung, HK Hynix, and Micron. And from what I've gathered through third-party industry experts, Micron is really the third out of three right now in terms of their capabilities to really give what the industry what they need. Not just from a capacity standpoint, but from a yield perspective, from a technology perspective, all that. Okay? They're not best of breed. One. Problem number two. There isn't a ton of differentiation at the end of the day when it comes to these guys. So, with all the profits they're making, all-time record profits, all-time record demand, the industry wants all they can produce. The industry wants all they can produce. If you were one of those companies, would you not produce more? Well, they're producing all they can. They're at full capacity. And what do you do when you're at full capacity and the industry still wants more? You build more capacity. And what happens if the industry builds too much capacity? Or if they just build more, right? If you just build more, then you're fulfilling more of the demand. You're offering more supply. You're shifting the supply-demand balance in a way that is negative for the industry. Samsung gets greedy, builds out more capacity to try to take market share and grow more revenues to make shareholders happy. And all of a sudden, the industry has more supply. The demand is the same. Pricing drops. Pricing drops, margins drop, EPS drops. And that's how you end up with a situation where a stock can go from 100 to 1, like what happened to Micron from 2000 to 2009. Okay, so be very careful about these things. A little lesson there for you. All right, let's get back. We went over this. We didn't talk about this, but still having the GDP data is still weakening. Now the Atlanta Fed is below the consensus. The Atlanta Fed was way above the consensus a few months ago, and now it's already down. We're all the way down to 1% as the estimate for Q1 GDP growth. Okay, of course, Q1 is done. We're going to go into Q2. Can't wait to see what the forecasts are there. This is problematic. We're seeing a slowdown in the economy. All right, we have oil prices elevated. All that stuff can produce problems. I can't tell you what kind of problems, how big the problems will be, when they will hit, blah, blah, blah. But what I can tell you is sentiment is in near red line territory and the market charts are in yellow alert territory. Be careful. All right, AI. This week's headlines very quickly. Anthropic, Mythos, cybersecurity problems. And this stuff leaked out. Okay, so this is an issue that we are monitoring and investigating. Okay, this is something kind of scary, but what do we need? Independent, third-party, industry experts to tell us what's what. I'm not going to give you an opinion prematurely over that, but look, as of right now, don't worry about it, right? Unless you're some big whale, some huge corporation, the bad guys are probably not going to use AI to wipe you out. But stay tuned, because we got to keep an eye on this. The government's already aware. They've got a whole project out there right now to make sure that this doesn't end up becoming a big problem worldwide. Project Glasswing is what it's called. You can look it up. So interestingly enough, we've been concerned about the Chinese, and it ends up being one of our own that provides the first major threat, which, by the way, can be a major threat to everybody else. So better that the U.S. start this than somebody else if you live in the U.S. and you care about us staying ahead of the rest of the world. Record AI funding. Look at this. This is crazy. AI startups captured 242 of the 300 billion. There were 300 billion of global venture funding in Q1, and 242 of it went into AI. Okay? That's what's going on right now. Because of what I told you about a couple months ago, that AI hit an inflection point that was as significant or close to it as the ChatGPT moment. And that's the agentic AI, right? As these models advance and accelerate. AI is not a bubble. Let's get into stocks. All right. So we talked about Micron. Be careful. I gave you ARM. I made the mistake. It's funny. The mistake I made was selling at 170 instead of 180. I would have been out at 180. In fact, when I sold at 170, I told people, broad audience, right? Not just my friends and family. I'm getting out at 170 because there's only 10 points left in this thing, but I almost guarantee we're going to get those 10 points and probably more. And boom, here we go. I mean, this thing has just gone absolutely parabolic. This is made for April 1st, rather. Where is it? April 1st. There's April 1st. 147 to 234. It's up 58% this month, and this month isn't even over. Okay? This is the power of AI. I saw this in 1999. Okay? And it's a little concerning because let's move to AEHR, a name that I gave you at 3 back in 2021. A name that I gave you again. I think it went from 2 to 52 in 2021. Boom, there you go, right? And then I gave it again. See that gold mine? Those of you who don't know, gold mine is the magic word, okay? I came up with the 3 stages of a stock. The great find, the initial hype phase. The wait time, where everybody waits for them to actually do what they're, you talk about AI data centers in outer space. AI data centers in outer space is a great find, okay? And once that hype behind the great find reaches its peak, then we actually have to see it happen. Where are the AI data centers in outer space? Bro, we're not going to see those proliferating for years. So there's going to be a multi-year wait time to actually see the promise, the potential of AI data centers in outer space. And during that time, the companies that get hyped during this great find phase, it's the great find, we're trying to find, it's like an Easter egg hunt. Let's find all the winners for this future trend. Once that hype reaches its peak, the wait time begins, and you don't want to be around for that. So you get the great find, you get the wait time, and then you get the gold mine. The gold mine is what? When you actually see stuff happening. When Air started getting orders from onsemi because onsemi was getting orders from Tesla, the stock went from 2 to 52. Then a rough patch hit. Not a wait time, a rough patch. It was already proven. Once you hit a gold mine, it's a gold mine. But EVs slow down. That's a rough patch. If you have a slowdown in an industry, that's a rough patch. We had a rough patch, but in the meantime, AI started blowing up. And what did I tell you? that at some point AEHR was going to be needed for AI. But we were waiting for that. And then boom, it hit a gold mine. They started getting orders, hard drives, AI accelerators, silicon photonics. Things I'd been taught. Silicon photonics, I was talking about with AEHR 10 years ago. That's how long I've known Gain Erickson, the CEO. Yes, I know him. Phone number in my, cell phone in my system. I call him right now. He will answer the phone. My boy. All right. I knew him when he wasn't worth $1 million. Now he's worth 40. Okay? Because of these gold mines that hit. But look where we ended up. Let's zoom in on the chart. Look what we got. As most of you know, if you don't know, put it in your notebook. The colored lines are Money Mark's proprietary research fundamental lines. You cannot draw these as a technician. Proof? Look at this. These are my lines for TSSI. Who would ever draw those lines where they are? Only Money Mark. Proprietary, fundamental, valuation-based lines. And those lines told you to sell at 20 before the stock went to 7. Those lines told you to sell again at 20 before it went to 30, but then came back down to 7 again. And because we were low again in the green line, and because my research and my contacts told me that a great Q4 was likely to happen, we got you back in. And what happened? The stock doubled from 7 to 15. And now we're out again. And in fact, you look here, right? We're high in the risk reward range, and this company hasn't changed from what I said it is, which is an overflow valve for Dell, which is not where you want to be. So I'm out. The risk reward isn't great there. All right, so that takes care of TSSI. We'll cross them off the list. We were talking about ARM. We talked about them. AEHR. We did the zoom in, right? And on the zoom in, what you find is the technical lines. These gray lines, the gray lines are technical. You see that channel? That's a nice channel. For those of you who don't know about this, if you can draw a channel, right? You could take advantage of the highs and lows as the stock moves up and down in between the fundamental range. Okay? So a technical channel is how a stock rises or falls from the bottom of a fundamental channel to the top of a fundamental channel. Fundamental meaning, what is the stock actually worth? Think of a house, right? A house has a certain value to it. When you go house shopping and you look in a neighborhood, if every house in the neighborhood's $250,000 and you see one of the houses selling for $300,000 and it's the same as all the other houses, guess what? You don't have to be a genius to say to yourself, this house is overvalued and you're not going to buy it. And if you find a house that's 150 and it's no different than any others, no problems, no nothing, it's identical to all the others, that's the one you want to buy. It's simple, okay? But with stocks, figuring out what that value is tougher because there's no neighborhood with identical houses for you to compare them against. Okay? There are other companies, but companies are much different than houses in a neighborhood, and people like to comp things. Because Samsung's valuation is X, Micron should be Y. No, they're snowflakes. I'm sorry. I've been doing this for over 30 years. I'm telling you right now, you can't do it that way. People do it that way because most people will believe it and fall for it. Don't fall for it. You need real valuation. The lines are different for every company. And once I draw a red and a green line, then you know what the valuation looks like. Okay? This is what it's going to look like in a worst case scenario. And if it goes below, that's great. That means the stock is selling even lower than the lowest point that it should ever sell for, in my opinion. And then if it goes above the red line, it's selling for more than I could imagine it being worth. Now, look, you saw with Kraken, it just kept going. So that can happen, right? But we got a couple of problems here. Number one, it's above the red line. Number two, it's above the top of its technical trend line also. This is danger, danger, danger. We made our money on this, folks. This stock opened the month at $30. It's now 99. How much is enough? You can take that money and move it into other stocks that are more attractive and make the same money. And that's the thing. I tell this story all the time, so I'll tell you the short version. I bought Apple at 50 cents and sold it for $1. And now it's 250. But guess what? The money that I got selling Apple and putting it into other stocks is now also 250. I didn't lose anything by selling Apple. Instead, I gained diversification. I gained a safer path to the same outcome. Okay? That's what you're doing. I don't care if air goes to 200. I hope it does. My boy gained. Beautiful. Now you'll be worth 80 million. But guess what? I'm betting based on my capabilities, which you see year after year after year, that if it goes to 200, that my money is going to go to 200. It just won't be in air. It'll be in safer names. That's what most people don't get. All right. So that's air. Nvidia, where we at? Not bad. I told you actually, despite Nvidia being highly valued right down here, that I was buying some Nvidia. Let me pull up. I'm gonna tell you the exact truth. I don't make things up here. I'm gonna go into my account and I'm going to tell. I'm not gonna show you. I'm going to tell you. You just have to trust me. Let's see. I'm up 14% on Nvidia. Where does it say my cost basis? 182. All right. So 182. See, so I don't say I didn't bottom take it. Some people tell you 182, either here or here. I said, you know what? I know Nvidia is close to my red line, but what I'm seeing in the industry right now says I have to own at least a little bit of Nvidia because it makes sense to me. I think it's a see that right here? Let me see. Let's get the risk reward lines in a nice spot so you can see. Come on. Freezing up for a second here. There we go. Zoom in. There's your risk reward lines, your red line, your green line, right? Despite the stock being here so close to the top, I felt that the odds of it going to the top because were high. Why? Because to me, they are operating on all 10 cylinders, if not more. And this red line represents where a stock belongs if it's operating on 10 cylinders. Now, the problem with operating on all 10 cylinders is that there's nowhere to go. You could operate on 11 or 12 for those who watched Spinal Tap. You could go to 11, right? But you're taking a hell of a chance there. But if you feel 100% confident that the stock is going to operate on 10 cylinders for sure, then you can make that bet that it'll go higher and at least get to the red line. So I bought my Nvidia at 182. And in fact, now that I'm looking at this chart now, right, we got above the red line. It was a gamble I told y'all that I was taking based on the cylinders it was operating on. You see now it's above the red line, kind of similar to what we saw here. I'm going to go in. I didn't even have time to think about this week. I'm going to sell it. I'm going to sell my Nvidia right now. And I'm going to find somewhere else to put it. And if I can't find somewhere else to put it, then it doesn't belong anywhere. Don't let it burn a hole in your pocket. I'll keep it in cash until I can find something good to put it in. Boom. Nvidia, gone. All right? Cold. I love Nvidia. Nvidia is they're the ones. There's no question about it. This is the heart of the AI economy. That doesn't mean I need to hold it at any price. That's the key. My allegiance is not to Nvidia or Marvell or Micron. My allegiance is to my money. Money. You're trying to make money. Are you trying to collect? We're not trying to collect stocks like baseball cards. You're not trying to complete a collection of stocks. You're trying to make money. You're trying to get rich. Just do that. That's Nvidia. Marvell. See? There's another one. I gave this to you down here at one of these white lines. Stock has more than doubled since. What did I tell you at the time? Let me see. Broadcom's probably up too. Broadcom's done great as well. Okay? We zoom in though. Let's see what we get. I wonder if we do a comparison chart to Marvell. Come on. Boop. Look at that. See? This is what I was hoping we'd see. I didn't, oh no, wrong chart, wrong chart. We want AVGO. There we go. There we go. This is what I was hoping we'd see. All right. What I told y'all at the time when I got into Marvell was Broadcom's getting all of the attention right now. But as we move into inference phase, look it up. Right, we go from training to inference. Inference is going to blow up. Marvell is going to have its day in the sun. And look what's happened here. Okay, great outperformance. If you sold your Broadcom and bought your Marvell, congratulations. I'm going to double check my portfolio right now. I'm sure I sold out of Marvell. I did. And if I hadn't, I would now because of where the chart is. Okay. Not just from a technical perspective, but from a fundamental perspective as well. Going back to the year 2000, right? We can adjust this if we want. We can even say, boom, maybe that's the right line, right? But what's important about these lines, and you see these lines are white, not red and green. That means I haven't completed a full assessment. But what's really important here, when you draw lines like this on a chart, two things. One, they have to be logarithmic. So you see right here, we're basically at the same level. Have to be logarithmic. If you don't know what that means, just write it down and ask AI later. What you see here is the line goes 5 to 10. From 0 to 10 is all this. 10 to 20 is only this. 20 to 30 is only this. You see? That's called logarithmic. I won't explain it to you. You need to learn that yourself. So one, the chart needs to be logarithmic. Two, then you've got to see the compounded annual growth rate, CAGR, of the actual line. This line has grown at 7.5% per year. You can see annualized on the box. It says annualized. The second to last line says annualized 7.5%. That's very doable, actually. Right? So would I be surprised if Marvell goes higher above this line? No. I'm just not going to take that chance because historically, at least from a technical perspective, right, this is about as high as it gets. We have the market at highs, sentiment at highs, the stocks reaching technical highs, if not fundamental highs. Be careful. I'm just going through these one-on-one. I didn't plan on telling you this. I didn't plan on putting so much cold water on the parade, right? But we just have to be honest. Yeah, thanks. Wrong chart, AVGO. I appreciate it. We're moving fast. See, it's not scripted, my friends. It's just what I know. We talked about Kraken. We showed you Drone Shield. All right, so that takes care of that. So that's where we stand right now in the world of AI stock investment. Can we go into bubble territory? Yes. Yes, we can. But we don't know that it's going to happen. And so what I did about that back in 1999 is I made sure I do what I'm doing now. Find the companies that don't appear to be fully or overvalued. Okay, let's just find new ones. Let's not be lazy and own Marvell and Micron and Nvidia at elevated levels or levels that appear elevated unless we know what the valuation is and we know that it's much higher. When the whole world, right, you've got literally hundreds of Harvard and Wharton MBAs on Wall Street doing these calculations. And if they saw that Micron was undervalued by 2x, they would be buying it. If they saw that Nvidia was undervalued by 2x, they would buy it, and those stocks would be closer to the fair value. You're now going against all of Wall Street, and the difference is, right, they had the same capabilities 3 months ago, 3 years ago. The difference is they didn't have the knowledge, the data, what I was telling you from the independent third-party experts about where AI was going. Half of Wall Street thought AI was a bubble. The other half thought it wasn't. Now everybody knows it's not. So where's your advantage? Your advantage is where You know something that other people don't. If you don't have that advantage, don't play. Why would you want to play a 50-50 bet when you can go out and not be lazy and go look for that bet that's 10 to 1 in your favor, 5 to 1 in your favor, 3 to 1 in your favor even, instead of a 1 to 1 bet? You don't have to do that, right? You don't have to do that, and that's how you get rich. All right, let's go. Let's go. One of the questions we asked for this week, and by the way, if you have questions, we're going to get to Q&A in about 15 minutes. We'll probably be a little bit late on that, okay? But as soon as we get into Q&A, I'm going to answer your questions. To get your question answered, if you have already asked a question, if your question marks aren't at the beginning of the question, I'm probably going to skip it. It's easier for me to see question marks at the beginning. Some people put 3 of them. That's great. They're easier to see. Put 3 question marks at the beginning of your question. I will answer your question. That's one thing. 2, do not ask questions about stocks that I haven't spoken about before. And in fact, do not put comments about stocks I haven't spoken about before. This is my show, not yours. I will kick you out. Do not troll. I will not be angry. I will feel pity for you, because mommy and daddy gave you so little love that now you only feel happiness by inflicting pain on others. Trolling does not hurt me, does not inflict pain on me. It inflicts sorrow and pity upon you, you poor soul who mommy and daddy did not give love to. That's such a sad thing. You now cannot go back in time and get loved by your mother and father. You have to die and be reincarnated for that to happen. I couldn't feel more sorry for you. Okay? And that's what you're going to get. So don't do it. I'll just kick you off the show. It's a waste of time, and time is money. All right. This report, months ago, I gave you this report and told you that AI and IoT were inflecting and blowing up in a manner that was going to send stocks through the roof. A lot of people, like, when you hear something new, that's when you need to pay attention. All right? A lot of people didn't pay attention. A lot of y'all, though, the smartest ones in here, looked at this right here that I put up on here and said, I don't know what the F this is, but I'm going to find out and see if there are any stocks out there that benefit from this. Okay, that's exactly why I didn't tell you what stocks would benefit from this at the time, to reward the people that take their pens and notebooks, the people that go out and look for the Easter eggs instead of sitting there with their hands out. Easter egg. Sure, I'll give you an Easter egg after everybody else is eaten. You'll be last in line, which means you'll be the last person to become a millionaire if you become one at all, because everybody else is going to be eaten off of you. Don't be lazy. So let's go over it. All right, I'm going to give you a list of companies, the connection points, the whole lay of the land. Right? And a lot of y'all know the first one I gave you was WATT. Beautiful. Look at what this thing has done for us. All right. There's your chart. Red lines, green lines, technical lines. This should actually be, these should be gray. All right, we'll make them gray. We don't want them white. White lines are generally preliminary red-green lines. White lines is basically a placeholder for what will eventually be red and green. We don't want to do that because we already have the red-green lines there. Did I do that right? There we go. Cool. All right. So there you go. The gray lines are technical. The red-green lines are fundamental. I gave you this stock down here around the green line, in fact. Actually lower. This green line is actually moved up. That's bullish. Okay, so I gave you this green line down here. The stock was at the green line and it's gone, and it's been moving up towards the red line, indicating that investors as a whole are discovering the stock and determining that they are operating on more and more and more cylinders, heading towards 10 cylinders of execution. Okay, let's break it down. Here you go. Notebook and pen out. So, what's happening right now in the AI, IoT supply chain industry? What is the supply chain? Well, think Walmart, right? When you go to Walmart, you buy a head of lettuce. That lettuce might have been grown in, I don't know, Colombia. I really don't know. By Dole, okay? Makes bananas, right? Or Chiquita makes, who cares? I'm just making these things up. But what I'm not making up is the actual function. So you get some Chiquita lettuce from Colombia, and it has to make its way to Walmart in Miami Beach, right? On the way from point A to point B, any number of things can happen. There's a certain amount of time it'll take to get there. There's a certain temperature of the vehicles that lettuce is traveling in, humidity, right? And the actual location of the lettuce on its path from point A to point B, among other things. And to Walmart, all of those things are absolutely critical. Why? Because the perfect situation for Walmart is for them to sell the last head of lettuce in that store at the exact moment that a new shipment of lettuce shows up at that store. That's perfect for them. No spoilage, no wasted money out, right? Buying inventory, you want the inventory to be flowing perfectly, seamlessly. And that's what makes Walmart Walmart. They have been the absolute ace in terms of technology. Used to be a customer of the company, the last company that I ever worked for, AMR Research, acquired by Gartner Group, ticker symbol IT. Okay? And they want full visibility because they want that lettuce to show up just in time and in perfect condition to sell the maximum numbers of heads of lettuce before the next pallet of lettuce shows up. They want everything to be perfect. And to do that, they need visibility into the supply chain. That's the supply chain. Point A to point B, that's the supply chain. Okay? So, in addition to that, the US government and the EU they both have put mandates in place. Okay? You've got FSMA 204 in the US, right? You've got, let me see. This is it right here. They're the government mandates. FSMA Rule 204. You've got DSC. It's on the screen. You can look at it later and jot it down, right? I'm going to show you on the screen. And then the European Union, they have a war on batteries. If you have a battery in a product, you're responsible for its disposal when the battery runs out. Okay? So what's that driving? It's driving the sensors. Okay? On that lettuce, that pallet of lettuce going from point A to point B, they're putting sensors on those pallets so that they can measure the temperature, the location, the humidity, among other things, of the lettuce to make sure it doesn't end up in a truck with a door open in 80-degree weather and spoil faster, have less shelf life, have less profitability, right? And the governments want that too. They don't want you eating spoiled lettuce and getting sick, in some cases dying. So they're putting these mandates in place. But one of them is a war on batteries because these sensors that track all of that information used to run on batteries. And they still do in many cases. Some places they need to run on batteries just because of the use case, right? But in many cases now they've removed the battery because the EU is making the vendor responsible for the disposal. And these sensors have gone from dollars to dimes in terms of cost. They're little stickers. Let me see if I'll find you a picture of the sticker. I will show it to you. There you go. That's these sensors look like. Okay, these high-tech sensors are like just little stickers and you stick it on, boop, 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 10 cents, 10 cents, 10 cents, 10 cents. If they're battery powered, you're responsible for the disposal of those things in the EU with the new mandates coming down. Nobody wants to do that. Nobody wants to do that. So they remove the battery. Okay? And now the battery for the sensor that tracks the product through the supply chain has to be powered by something. And that's where WATT comes in. Now, there are competitors to WATT, but from the research, from the independent third-party industry experts that I was able to find on this topic, Watt has the best solution. And in fact, a solution where it is, in many cases, the only thing that will work with enough reliability to satisfy somebody like Walmart. So as you could guess, Walmart became a customer of WATT, and they are driving revenue for Watt through the roof. Okay, 85% of their revenue last year was from Walmart. That was for 410 stores. Do you know how many stores Walmart has? 4,700. And they want them all filled with this technology by the end of this year. 410 last year, 4,700 total by the end of this year. And it's already been said that they're up to 1,500. So to go from 410 to 1,500, that means you have had to add 1,190 stores from the end of last year to where we are right now. Less than a third of the year. Nearly 3 times as much in 1/3 the time. That means Watt's revenue from Walmart obviously going up and to the right. All right. Let's continue the story here. So you got the war on batteries, and then you have basically the EU has the similar equivalence to the EU directives that I showed you above. So that's that. Okay, they're going into effect at different points in time, but what I am going to tell you is even FSMA, which, let's see, the deadline for FSMA Rule 204 is July 20th, 2028. So just over 2 years from now is the deadline. However, Walmart is forcing its suppliers to act now. Okay, part of the reason is that to comply with this mandate, when the government comes and wants an audit of your information, they want 2 years of data. Okay, that's one reason. And the second reason is that Walmart wants to make sure that everything is working on day one. On July 20th, 2028, they want to make sure that every supplier is up and running and working properly to this mandate. And the ones that aren't are kicked out and replaced by somebody who does. Okay? They want to do that all in advance. Walmart doesn't stick around, use a different word, waiting for July 19th and say, oh, the deadline's tomorrow. Let's put all this stuff into place. No, they're putting this place in. They've started last year. They started last year, and that's going to continue. And there's some information I'm going to tell you in a little bit that's really exciting about this. But let's continue with the rest of the story here. So you've got the supply chain that needs to be tracked. You've got the sensors that help do the tracking. You've got a company like Watt that sends energy over the air into these sensors so they don't need a battery. You're certainly not going to plug a little sticker into the wall, right? Energus sends the energy downstream to the sticker. The sticker powers on automatically and starts sending information back to the Energus box. The Energus box then sends the information into the cloud, maybe AWS, stay tuned. And then in the AWS cloud, the applications reside to crunch that data, analyze that data, have AI act on that data, send information to the partners. So all of Walmart's suppliers sending all that data back to Walmart so that they can keep the supply chain operating smoothly. Okay, so you've got the supply chain, you've got the sensors, you've got the power source of the sensors. You have the applications, and I'm going to tell you about 2 companies right now. I'm going to tell you my favorite is obviously Watt, W-A-T-T. Okay, but there's a couple others that are of interest. All right, one is Identiv. Of interest, by the way. I own a very small amount of Identiv. But shout out to Story Trading, who's been on this name. These guys have shed their security business to become a pure play on manufacturing the tags. Okay, so Energus powers the tags. Who supplies the tags? You got a company like Wiliot. I'll put the name up here. Right? There's Wiliot. It's a privately held company. They are a vendor of the tags and software and everything else, right? They are partnered with Energous to power their Gen 3 tags. Do you know who actually manufactures the Gen 3 tags? That would be Identiv. Okay. Now, I like what Identiv's doing. Here's the positive and the negative about Identiv. Okay. Identiv, obviously making the tags. The tags, that's a bullish, right? That's a great trend that we're in. But they have this huge facility to manufacture them. That's also bullish if you can fill the facility with customers. If you have enough customers to fill the facility. If you don't, then your profits will suffer. And that's the problem that they are dealing with right now. Okay? Now remember, I do own some of the stock. I'm not short the stock. I own the stock. But in small quantities, because what I'm waiting for, wait time, is, and you see the revenues here, right? I'm waiting to see them get more customers because that's what they need. They're going against some formidable competition. Avery Dennison is actually the 800-pound gorilla in this space. I do have optimism around Identiv's ability to get more customers because of the demand in the space and because they're good at what they're doing. But you see the revenues haven't really responded yet. 5 million, 6 million, okay? And in the meantime, look at the profitability. Operating income, negative 4 million. Their margins are only 20% right now. This company has to grow substantially. These revenues have to multiply in order for the profitability to reach zero. Okay? They are burning cash. They did get cash from operations last quarter, but that was, you got a change in inventories contributing to that, things like that. But this is a company that is burning cash in general, sustaining losses, and that will change as if they get more customers. And the nice thing about that is if they do, the factory's built. It's a sunk cost. So there's going to be great operating leverage in the business. As new business comes in, their margins are going to increase. You can see that already, going from negative 10%, 9% to positive 11% to positive 18%. There's a limit to that because it's a competitive industry. This will never go to 90% or something, but the gross margins will increase as they get more customers. The SG&A and R&D expenses do not have to rise as the new customers get ramped up. So a lot of revenue will drop down to the bottom line. At least a huge portion of the gross profits will drop to the bottom line, to the point where eventually they can gain profitability and so some growth, et cetera, et cetera. But for now, the reason that it's considered cheap, and that's fine. The reason I own the stock. You have $100 million market cap, right? But look at the cash, 128. Well, Mark, what's the problem? It's trading for less than cash. Yeah, but were you listening? Take the cotton out of your ears. They're burning cash. They're going to have less cash between now and when they reach break even. And the question is, how much less cash? Now, the good news is that with a market cap of 100 million and 128 million in cash, you've got some cushion. They can burn 28 million and they're still only trading for cash. Okay, so that's not an unattractive thing. The thing is that they're in a competitive space and they haven't proven it yet. I want to see a little more proof. You know my rule, and if you don't, write it down now. It's better to show up in the second inning than to get rained out. I like to play the game between the second inning and the eighth inning. Right? That's the meat of the game. That's where you make the most money. So that's them. That's the manufacturer of the tags. You got Williot that actually sells the tag. They put their name on the tag. And then you got another company called Repositrak, TRAK. This is an interesting chart. And these guys are basically a middleware hub. They have a software as a service that is a hub of information flow. Okay? because everybody has different software. Walmart has their software, and there's no way that if I'm supplying Walmart with a product that I'm going to use the same software as Walmart. Walmart's huge, okay? They use like SAP, Oracle, things like that. I'm going to use small company software, and that produces different data in different formats. And that different data in different formats isn't going to necessarily speak the same language as Walmart's language. So what ReposiTrak has done is created basically a middleware hub where everybody can send their information into their software system, and it delivers it to Walmart, for example, in the format that Walmart likes. Okay, so they're a great middleman of information, data. Okay, and if you look, I own a bit more of ReposiTrak than I do of INVE. I own the most of WATT. Let's go to the transcript here. And one thing that was interesting, so look guys, when you invest in a company, spend the 10 minutes to at least read the last transcript of their last earnings call. You're putting money, you're putting your money, you're trying to become a millionaire. You can't spend 10 minutes to read a transcript. This was beautiful. Thanks, John. ReposiTrak had an eventful quarter. Some of that shows in our numbers, but much of what we accomplished was behind the scenes. While we're delivering profitable growth from each of our solutions, we continue to add to the moat around our business, specifically the traceability business, tracing point A to point B. The ReposiTrak Traceability Network, or the RTN, is already the industry leader. That's what we look for. We want to get validation of this. Don't trust the company saying we're the industry leader. I don't believe you. I'm going to go find out from an independent third-party industry expert. The queue to join our network is much larger than our current installed base. That is the line of the transcript. Okay? And it makes sense. If you heard and understand everything I said about how this industry is set up, from the mandates down to what Walmart wants in terms of a smooth supply chain, to how the sensors interact with the energy source and send data up into the cloud that goes into the applications, right? The data goes into a system like this and can get shared with all the constituents, and their applications can run and do analysis and send data back into the system, and the supply chain runs smooth. That's the closed loop system that I just gave you, right? Then you can understand why in an era where we have AI and IoT making this technology perfect right now. AI has never been stronger. And the IoT, the Internet of Things, the sensors, have never been cheaper. So you've got powerful analytical technology meeting super cheap data creation technology. It's a perfect storm. But the perfect storm gets met with industry mandates from governments and from corporate leaders like Walmart driving demand. All of a sudden, because guess what? IoT wasn't so cheap a year ago, 2 years ago. In fact, a year ago, Wiliot did not even have battery-free tags. So there was no demand for Energus by Wiliot because Wiliot's tags were powered by batteries. Now they're powered by Energus in many cases. Okay? So that drives an inflection point for Energus. The mandates drive an inflection point for companies like Identiv and for companies like ReposiTrak, right? And of course, Wiliot, privately held company. These are the things that you look at. Now, if you haven't heard about all this from anywhere else, that's because a lot of investors don't know about this yet. And what you see here, what's really interesting about the ReposiTrak chart, is that the mandates were actually announced a few years ago. But because of the difficulty, AI wasn't so powerful. The tags weren't so cheap. All these things made it difficult for the industry to meet the initial deadlines. And so the government said, okay, we're going to give you an extra couple of years. And so ReposiTrak actually went from $5 to $25 on the initial wave of interest because of the government mandates being put in place, but then collapsed on the delays because the deadline's being pushed out. But now we see the action in the industry. Walmart's moving, Wiliot's moving, everybody's moving, everybody's selling. There's no excuse now. There's no need for the deadlines to get pushed out any further. Okay, so all we need now is for ReposiTrak to break out of this downtrend, and it could be off to the races if what they said about the queue to join their network being much larger than their current installed base, right? And that's what I think is going to happen, in fact. By the way, I promised that I would tell you about the Russell 2000, because next Thursday, the Russell 2000, right? We're calling Russell. Russell is going to lock in the market caps. They're going to say, who are the 3,000 largest companies, the 3,000 largest public companies that qualify for our criteria to be in the Russell 1000 and the Russell 2000. We focus on the Russell 2000 because if you get into the Russell 2000, it it's required for institutions, big ETFs like IWM. They have to buy the stock. Over $10 million worth of stock if they get into the Russell. Okay? So, and now there are also ARBs that take advantage of knowing that to either pressure stocks that are getting kicked out or buy stocks that are going to get put in. We do that in advance. Including me. Okay? And what you see, my belief is that part of this decline in ReposiTrak is because it became clear at about this point that they were going to get kicked out of the Russell. Now, don't go freaking out over this. That's cool. Because if everybody already knows they're going to get kicked out of the Russell, then it's already priced in for the large point. Okay? So it's not a big deal. I own a good chunk of this company because I'm not afraid of them getting kicked out of the Russell because it's already expected. Right? Here's what's not expected, though. If this stock gets to 9 by Thursday, they don't get kicked out of the Russell. And all the people that shorted the stock expecting it to get kicked out are going to have to cover their shorts, and then the stock goes even higher. And if it does, you see, it can just break out. Now, if that doesn't happen, I'm not betting on ReposiTrak going to 9 by next Thursday. That'd be dumb. Only God knows if that's going to happen. If it doesn't happen, no big deal. I still have what I believe to be a good company feeding into a trend that is going to last for the next couple of years. Okay? But there's a kicker in that if the stock does get to 9 by next Thursday, it's just going to take off even quicker than if it doesn't. That's all it means. It's just a timing thing, right? And by the way, as word gets out about these names, it might just break out anyway. So even if it doesn't get to 9 by next Thursday, let's say it gets to 9 2 Thursdays from now. Well, guess what? That's also a breakout. You see? If it takes till, let's zoom out a little bit. If it takes till July for it to get to 9, look at this. That's a breakout. Look at the chart. See? That'll be a breakout. And that will get more traders' attention. That'll get more investors' attention. More people will look at this and say, what's going on? Some of them will go back and watch this video because it'll be tagged on Twitter or whatever. They're going to learn about the company and they're going to say, oh, this company looks undervalued. It looks oversold. People overreacted because the mandates drove the stock to 25 in the first place. And the mandates are back where they were back here. Right? Back here, people thought it would be a 2-year cycle of mandates, and now we actually have the 2-year cycle of mandates. So wouldn't it stand to reason that the stock takes off again? Probably. Right? Should it go to 25? I got to do my math first. All right? So stay tuned on that. But in the meantime, I did buy myself a nice good slug of this, which, by the way, because I'm talking about it for the first time so positively, I am on an embargo. I will not trade this stock for 72 trading hours, 3 trading days. Okay? That way you know I'm not some pump and dump. Those 10,000 clowns out there who don't know what they're talking about and just hope they can get you to push the stock a little higher so they can make 10 cents on a stock. No, I'm here to make not dimes, but dollars, and I don't need y'all to do it. I don't need to do that on your back. I did this for 20 years before I ever wrote an article for Seeking Alpha. I was making 40% a year before you ever knew who I was, and I'll make 40% a year if I go away. All right? It's just a matter of how long does it take for everybody to catch on to the research that I've done and that experts have given me. All right, let's keep going. We don't want to lose everybody's attention here. Let's go. Okay, so we're going to speed it up because it's already 3:15. We're going to have to go straight to the lightning round on Q&A, but I promised I would take people through this entire process. So, by the way, all right, so Repositrack at $9, they probably stay in the Russell. Watt, if they get to $30 by next Thursday, they probably get into the Russell, and that will force $10 million of buy-in. That would be a big surprise. Nobody is handicapping Watt getting into the Russell. That would be a surprise, and that would drive the stock probably even higher if that happens. By the way, Infuse Systems, I have sold puts on Infuse Systems, which means I am long the stock effectively. Infuse Systems is getting in. Okay, and the last time they got in to the Russell, this is what happened to the stock, and the stock is starting that same action now. These guys are getting in. That's all I have to say about them. But getting back to Watt, I've got some new information for you on them. By the way, you can read this later for the sake of time. This will give you a little bit more color on what I talked about and how Walmart is actually tying together a lot of these companies that we talked about today. I'll put this on the screen as well so you can see that. Okay. Boom, that's enough time. All right. So boom. We'll leave that for there. We talked about this, so that takes care of that. I showed you all the tags, so that takes care of that. Big news. All right. It's funny. I'll give you the big news at whatever point in time. I didn't even start the show by telling you I would give out big news today, because I don't care. I don't care if you watch or not. People tune in for the first 5 minutes. Okay, he must have said the most important things. I'm going to tune out now. The lazy people get punished. I intentionally punish the lazy people. I will throw the biggest bone at y'all dogs in the middle of the show, because that's when I think people will be tuned. The lazy people tune out. The lazy dogs get no bones from me. This is Sparta. Here's the bone. I showed you this before. This is nothing new to you. Okay? AWS, Amazon, is a partner with Energous. They brought Energous in as a partner. Why? Well, if you listen to what I told you, right? The data goes from the sensor into the Energous box into the cloud. The cloud. Oh, AWS is the cloud. And applications crunch the data and everything, all this stuff goes on. There's a fire hose of data going into the cloud. That's money for Amazon. AWS makes money from data and application processing taking place in their cloud. And so they know that Energous is an enabler of that data going into their cloud. So not only did they make Energous a partner, but a couple months ago, they upgraded Energous to an ISV Accelerate partner. And what that means is AWS said, you know what? We want to show everybody what you do, and we will subsidize. We will put money towards a proof of concept to show a customer what your solution can do, and we will pay our own salespeople when our prospective customers buy your solution. If that doesn't sound powerful to you, you need to rewind and listen to it again. But here's the big news for today. When I showed you this, when I announced this, when you saw the stock reacting to this right here that you see on your screen said 5+ AWS customer launches, which was bullish enough because we knew about Walmart. And the bears, the stupid, idiotic, clown bears out there, when you have an ATS, shut up. You don't know the difference between a bullish and a bearish raise. You don't know the difference between an inflection point, an IoT, and an AI. All you know is a chart, and I think I can make my 15,000 followers move the stock 10 cents and I'll make a dime. F you, stupid. Because While you were saying they only have one customer, a few weeks later, Energus comes out and has a slide on their new investor deck showing 3 customers. And one of them is Amazon, not AWS, Amazon. Now they have 2 Fortune 10 customers, stupid. And another one is a large customer, a large company we think is British Tobacco. Huge company, okay? And we had 5, in addition to that, 5 plus customer launches on AWS, which could be proofs of concepts, but guess what? Proofs of concepts, some percentage of them become actual customers. So you went from 1 customer to 3. And then you had 5 plus AWS customer launches on top of that. But wait a minute, Mark. You said 5 plus. My screen says 20 plus. Oh, that's the big news. In just a couple months' time, this just happened yesterday, folks. This tag now says 20 plus, not 5, the number 5, 1, 2, 3, 4, 5. The number 20 is 4x. When do you see anything go 4x in a couple of months? Oh, Anthropic. That's the last time I saw that happen. That's what's happening here. It's not 5 plus anymore. It's 20 plus. This thing is absolutely blowing up, exploding. Okay? Big news. I would have expected this to go from 5 plus to 10 plus, maybe from 10 plus to 20 plus after that. Nope, straight from 5 to 20. This stuff is being shown everywhere. And it makes sense. Government mandates, Walmart mandate, IoT super cheap, AI super powerful, AWS actually selling it and subsidizing the proofs of concept. Why wouldn't this happen? Stupid, you Fugazi clowns out there. Stupid. And then, of course, you got this. This was already out there, by the way. I mean, any clown could have seen it if they weren't lazy and just trying to manipulate you investors. Okay? Look, Amazon EU, WFM, Whole Foods Markets, not Walmart, Whole Foods Markets. That's also Amazon. Amazon Fresh, multiple facets of Amazon. Tosca. Tosca's a huge company. McDonald's, I've heard of them. Mondelez, Monster Company. 7-Eleven, I've heard of them. These are companies all doing proofs of concepts with Williot and growing because AWS says 20 plus. There's only 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 on this list. And this list was more than 10. This list was 15 long when the AWS site said 5 plus. Okay? I got rid of the tab. I didn't mean to do that. We'll get it back. All right? So boom. That's the huge news on what the train keeps running. By the way, they have now announced that they are going to come back and start doing quarterly earnings calls again. They stopped for a long time, no earnings calls from WATT, and now they're going to have one. Do you think they had a bad quarter and decided, you know what, we had a real crappy quarter. Let's start doing conference calls again so we could tell people what a crappy quarter we had? I mean, sometimes it's just that easy, right? And sometimes the clowns still can't get it right. Do you know why? Because the clowns are involved with rings of other people that are there to pump and dump. I have been given reports, detailed reports on the activities. I want nothing to do with it. But those people need to be careful because, like, I've got 10,000 fans out there. And when somebody attacks me, I've got people that will investigate those people that attack and see if there's something that they need to be found out about. And what I learned about these guys, like if these people who found this out about you go to the SEC, my. I'm not a snitch, but other people might be. Be careful who you're effing with. Stupid. Gatekeeper announces another $1.7 million school bus video and subscription contract with Atlanta Public Schools. Enough said. All right, another nice little win. 1.7 million is pretty good. I mean, they do like 34 million a year, so that's 1/20th of their year. Boom, right? They got these big deals to go along with it. They're knocking them down recently. Boom, 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 all in the last few weeks. So we're starting to see some action again. It actually is reminiscent of what happened last year when they signed a bunch of deals in the spring and summertime. So maybe it's a spring and summertime thing. Because look, each of these headlines, you got bus, bus, and bus. This is for, these are school buses. This is for paratransit. But three out of the last four announcements were school buses. So maybe it's school bus season. Probably. All right. I'm going to give you a halo name. High assets, low obsolescence. Look it up. Google halo names. It's all the rage on Wall Street right now. Okay. So you need to know about this. You can find other stocks for yourself. But one halo name that I talk about here, TPCS. Okay, there's your chart on TPCS. Red and green lines, nobody else is going to draw. You see, it doesn't make any sense. Technical people would draw something completely different. These are proprietary. But what we have here is new news this week, okay, that the Department of the Navy is requesting funding. Trump, he wants to triple their spending on the military. Now, whether you like that or not, you can make money on it. That's the important thing, right? I don't care about the principle of the matter. I'm here to feed my family. I'm here to get rich. I'm here to make the next million so I can go spend my next vacation somewhere. I can get a bigger penthouse, okay? Jamie Dimon's got a big penthouse right next door to mine. Maybe I can buy his. You feel me? Everybody can always get bigger. And when it's easy, why not? This is fun. I'm playing a game here. And the government said they want 1 Columbia-class submarine, 2 Virginia-class submarines. Okay? So I go to my TPCS model because TPCS is the exclusive provider of specific parts into Virginia and Columbia-class submarines. In fact, 91% of TPCS revenue comes from their monopoly on specific parts, not the whole submarine, specific parts for Columbia and Virginia, as well as the CH-53K King Stallion helicopter, CH-53K, remember it, and the F-15EX fighter. All right? So we already got, out of those 4 things, we got the Columbia, boom, Virginia, boom. Oh, look, CH-53K, boom. And also the F-15EX. All in 1 week. Air Force eyes massive boost for the F-15EX fleet. In 1 week, we got all 4 of TPCS's programs. No press release from the company. This is research. This is how you figure out first that you want to buy a stock before everybody else does. Before it becomes a press release, before it becomes news. It's research. Research becomes news. News becomes a press release. All right? Not necessarily, but that's the order. So if you do research, you're on the front end of all that other stuff that happens, right? All those things that I told you about Watt became a press release. They announced these things later, all right? Not everything, but a lot of that stuff. And you made money off of that. That last major press release they put out and the stock was up, 38% in a day? I had told you all that stuff weeks before. Stock didn't go up 38% when I told you about it. Why? Because you're a limited audience. And then when the world finds out, that's when you find out that I'm not here to blow smoke, talk BS, talk about the past. I'm here to figure out the future because the future is what stocks are based off of. Okay? DCF. Discounted cash flow, but F can also stand for future. The future discounted cash flows. So I got to go into TPCS model. And what you find is, for next year, I am not counting on 2 Virginia-class submarines. You see that? I'm not counting on 2 until 2030. So if this number goes up to 2, Columbia-class, I don't have 1 here, I have half. I have these submarines taking 2 years to build, not 1 per year. The Navy's asking for 1 in a year. They're asking for 2 of these in a year. They're asking for 22, I think, or 24 of these. What was the number? It was a bigger number. Screw it. We don't have time for that because I know the bottom line. And the CH53Ks, they want 22 of these things. I have to up all these numbers. And if and when I do, and I will, because I have to, because these numbers are based on what the US government wants. Okay? And so I have to adjust these numbers to the new numbers of what the US government wants in order to predict what TPCS's revenue will be if the government gets what they want. And when I do, this number, this revenue number goes up by $20 million. It's simple math because you input the units. I already know the expected per unit revenue, and then you just multiply. Okay, units times price per unit equals revenue. And that, my friends, if you add $20 million to TPCS's revenue, that increases their EPS by 50 cents. A 50-cent increase in EPS on a stock trading for $4. These guys just need to get out of their own way because they've been their own worst enemy in terms of execution. Okay? And guess what? The shareholders are getting fed up with it. Just like I told you a couple years ago that the shareholders were fed up with the board and they got rid of 2 members of the board as a result of that, ultimately, through a vote. I voted my shares, you probably voted yours, and boom, the board was wiped out because they don't own enough shares to stop us from inflicting what we want. We want. Okay? And what we want now, we are not a group, by the way. That's illegal. You can't form a group and conspire against a company, right? But what individuals want as a whole is for execution to take place in this company, and enough shareholders that I've spoken to have run out of patience so much that one of 2 things is going to happen. Either the CEO is going to get wiped out, one of 3 things, and or the board will get wiped out completely. The 2 new members will stay. The rest of the members will get wiped out the same way the first 2 got wiped out. Okay? And or number 2 major, right? That was one thing. The other one is they get sold. Because we're fed up. Just sell the company to GHM. Because look at that chart. That looks nice. That's what TPCS's chart's supposed to look like. Because they have the same sort of dynamics going on, and yet that's what this chart looks like. Okay? If they get their act together, the stock chart should look the same as GHM, which is executing. And if not, sell the company to GHM, and GHM will get the job done itself, because I met this management team years ago. I've met this company multiple times. These guys, bop, 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 they execute. They're not the most exciting company, but they get the job done. And that's all these guys need to do. And if they can't, then guess what? There's a good chance that the shareholders are going to kick out everybody, sell the company, and boom, right? And if they sell this company, by the way, let's go to valuation and then we go to Q&A because it's 3:33. We're way over time. The market cap is 40 million. By my account, these guys have equipment. You won't see it on the balance sheet because of depreciation, but they have equipment that is still working perfectly fine, worth at least 25 million. In addition to that, they've been given another 25 million of free money from the government to buy additional equipment. Why would the government, when you see somebody increasing their capacity, Air increasing their capacity, Watt increasing their capacity, Tech Precision being told by the government to increase their capacity. There's usually only TSSI when they increase their capacity. There's usually only one reason you do that. Because more demand is coming, more revenue is coming. Okay? And we know that already. We now know that because the government's asking for more of these. The government's asking for more of these. The government's asking for more of these. And TPCS sells every single one of those. So we have a $40 million market cap with $50 million of equipment that is poised to be fully utilized. When you buy $50 million of equipment and fully utilize it, You're making a profit on that 50 million, so it's worth way more than 50 million. $50 million of equipment sitting in a warehouse is worth less than $50 million of equipment running 24/7. So we've got a very nice floor, and if you wonder why the green line is where it is, guess what? That's why. Because the stock shouldn't trade for less than the actual assets that are being utilized for government orders that are increasing, whereby competitors' stocks are going through the roof. This was a 10-bagger, ladies and gentlemen. A boring-ass 10-bagger in GHM, and all TPCS has to do is get their act together and start executing against all of this demand. Whew. All right, so that's that. We'll leave this chart here for now. Did I miss anything from what I want to tell you guys today? Nope. Oh, there is one thing. So, semiconductors, I forgot to tell you about. Okay. This is a very interesting little chart that I created for you guys here. Okay. I need to make this bubble a little bigger so it shows up on the scaled out chart. There we go. Okay, beautiful. Semis. This is the chart of the semis, the SOX. Okay. Now, the SOX has only been around since 2001. Okay. But you can reverse engineer the SOX to calculate where the SOX would have peaked at some point in the past. What I was most interested in is where would it have peaked in March of 2000, the peak of the internet bubble. Okay. And what I found out is it would have been 55, which is right about there. Okay. Then I drew a line to the current day to see the CAGR. I told you that earlier, compound annual growth rate, to see what that represents. And it turns out to be about 9%. Why that's important is that I feel that 9% is an appropriate long-term growth rate for an entire industry like the semiconductor industry. Okay. And what you find is where we are now matches up with at a 9% CAGR. At a 9% CAGR, where we are right now with the SOX in terms of pricing is equal to the peak of the internet bubble. And why that's important is if that's correct, the downside over the next couple of years, if there is a burst in the economy, if there's a slowdown in spending, and trust me, I don't expect that yet. Not right now, because I'm bullish on the industry. But as I told you before, so is everybody else. So you saw the SOX, look at it. The SOX has gone up 180% in 1 year. An entire industry is up 180% in 1 year. I made 180% last year, but I had to work my ass off. I could have just bought the SOX and just kicked my head back and done nothing else and made 180% on an entire industry. That's crazy. Okay? That's problematic from a risk-reward perspective. The last time we saw a movement like that, it collapsed. Okay? Because the expectations got too high, the valuations got too high. Not because the bullishness wasn't warranted. It is. It's just that once everybody's bullish, who's left to be bearish? Who's left to buy if everybody's already bought into it, right? So we saw back in 2000 when the bubble burst, we went from 55 on the SOX to 8. And ultimately in the financial crash to 7. Okay, so be very careful. Now, look, the SOX can go higher because if the real CAGR, only God knows what the right CAGR is for this industry, but if the CAGR is, let's say, 10.4, then the SOX can go much higher. The SOX can go up another 35% or so. But you're risking the hope that we go into a bubble, right? Because you see the white lines, those are my preliminary red-green lines, and the gray lines, which are technical. We're at the top of both. We want the opposite. You want to be buying at the bottom of the technical line, closer to the bottom of the fundamental lines. The perfect time to buy the SOX was here in 2009. When it was at the bottom of this line, look at this. If I extend this back, right? You were in the low end of the channel here, the low end of the technical channel, and the low end of the fundamental channel. Here, in 2016, the low end of the technical channel and the low end of the fundamental channel. Here, in 2020, COVID, still on the low end of the fundamental channel and at the absolute bottom of the technical channel. This is where you wanted to buy. You bought here, boom, 164% in 2.4 years. If you bought here, boom, 160% in 2.2 years. If you bought here, boom, 240% in 1.6 years. Here it happened again. Boom, 130% in 1.8 years. And then one more time here during the tariff tantrum, boom, 184% in 12 months. This is how you make money, okay? Not by buying at the tops. Technical top, fundamental top. And maybe the fundamental top should be higher. I don't know. But why would you want to take the risk with the stocks at a technical peak and possibly a fundamental peak? Let's go to Q&A. Let's see what we got here. We're immediately into the lightning round. We have limited time today. I hope you listen. Look, and if you love what I do, give me the thumbs up. Hit the subscribe, hit the notification bell. Sometimes I'll go live other than Friday at 2 o'clock. Those who aren't lazy will get rewarded. Those who don't, I'm not going to go out of my... If I do a surprise live, I'm not sending out invites. I'm not going to send you an invite for a surprise live. I'm going to reward the people that hit the subscribe and notification bell, and they'll be the only ones getting the surprise information. I do not like lazy people. I do not like people who do not take a pen and a notebook for their well-being, for their millions. I'm here trying to make you millions, and you can't buy a pen and a notebook. How does that sound stupid to you? I hope it does. Because back in the day, I was charging $3,000 per hour for my consultation. I'm giving you 2 hours. That's $6,000 of my time, and you can't buy a $1 pen and notebook when I'm doing this for you? That's so crazy. That's so crazy. We can't even describe it. You should be ashamed. You should be ashamed of yourself if you can't understand the severity of that and why you are not making millions. It's simple. Hey, Mark, on VTSI, given the company's cash position and backlog visibility, where do you see the best opportunity currently? Where do I see the best opportunity currently? I don't understand the question. You're going to have to re-ask the question. I mean, VTSI is VTSI. I've talked about it many times. There's nothing new about them, right? Hopefully the chart comes up at some point here on the screen. There you go. There's the chart. They've been in a rough patch, right? We're waiting to see if they come out of the rough patch. There's reason to believe that they will, but we're still waiting for it. We might already be in the first inning of them being out of the rough patch, but I like the second inning. Once I see the second inning, I know the game is on, right? We don't know the game is on yet with this one. With inflation going up, but the Fed not raising rates, will that cause more capital to flow into equity markets seeking higher return? There's so many facets to liquidity. Money flowing into the market. Flowing is synonymous with liquidity. And there's a lot of things that play into liquidity. China, the Bank of Japan, the Fed, there's all kinds of, there's no simple answer to this, my friend. Mark, are you interested in taking another look at electroCore now that they have a new CEO? No, because the whole reason I got excited about them turned out to be a fugazi. The CEO lied about it. If the new CEO says that everything the old CEO said is actually true now, then we'll come back to it. Until then, no. Because the old CEO was doing the best job he could. I have no doubt about that. I had a really, really good relationship with him until I got that false information from him. On multiple occasions, by the way. A whole room of people witnessed it. He claims he didn't, but the whole room of people said he did. So who's telling the truth? I'm sorry. Nice guy and all, but something went wrong there. And I don't think he's a crook or a fraud or anything. It's just, I don't know, something had to explain that. But the fact of the matter was, he was doing his best to run the company. Regardless of the wrong data that I received, he was still doing his best to run the company. And I'm sure the new CEO is too. So what's the difference? No, is the answer. Been doing some due diligence on TPCS. Would like to bring up some of the fines with you. Would be open. Yeah, of course. Look, if you find information that I haven't provided already, that is like you think is special information, not some BS you found in some blog by one of the 10,000 clowns that you haven't vetted yet because you didn't get their real name, their real credentials, and their real-time performance tracker going back 10 years. I don't want to hear from those clowns. I don't want to hear from anybody that hasn't been vetted to not be a clown, because I spend my time speaking to real experts who I know to be real experts. Why would I even pay attention to somebody who might be a clown? Right? I'm taking my chances of wasting time. But if you have something special, yeah, send it to me. I mean, you go to my website. At the bottom of any of these articles, there's a comment section, and that will get to me. All right, so you do that, and I appreciate it. That's part of the reason I do this. I have literally dozens of people that now feed me information every single week that I feed back to you here. A lot of the picks, Drone Shield, Kraken, TSSI, those names all came to me from outside sources. That's what happens when you become a trusted source, because I have the contacts to vet information, to analyze picks. I have the know-how to figure out valuation, and then I reward the people that give me those leads and information with the first dibs on finding out what I found out. Okay, so yes, but don't waste my time, because if you waste my time, then I just won't be dealing with you again. You feel me? I might kick you off the channel. Don't be afraid because of that, but don't send me no BS that you saw on stock twits or anything like that. I don't deal with that. TGen chart, still waiting for the second inning. I mean, I told you guys that was a stock to sell. All right, it's making a little bit of a comeback now. I haven't changed my opinion on this, and I don't think I will. Geodrill chart. Are they in a rough patch? Yeah, they've been in a little bit of a rough patch because there's seasonality in their business. I think they're going to have a phenomenal Q2, which we are in right now, and the stock is trading for far less than the value of their equipment. This is another Halo name, okay? Heavy assets, low obsolescence. This company should be acquired for maybe double what it's going for right now. Nvidia is aggressively moving towards 800-volt architectures, and Navitas seems perfectly positioned. Can you pull up the chart? Yeah, I can pull up the chart. I've talked about Navitas in the past. We made money on Navitas in the past. I don't know how to value them, so I dropped it. I can't wrap my arms around it. Sometimes I can't find an independent third-party industry expert to give me the lay of the land so I can do the math. I can't do the math on every company. That's why I don't take requests, okay? And in this particular case, that's what happened. I had generally positive feelings about Navitas, but I just couldn't validate them, so I had to let it go. AVX. We're not covering AVX anymore. Let's make that clear right now. I gave that to you as a trade. Thanks to IPO Candy. Go to IPO Candy for more on this. When the stock went public, right here on this Friday, I came live, and right about here, what was it? This Friday, there you go, 2 o'clock on Friday, 1 week ago, I came here and I told you, courtesy of IPO Candy, not my analysis, IPO Candy's analysis, that this stock was worth closer to 40 than 20. Okay? And this is a multi-billion-dollar company. So this stock didn't take off because of me or because of IPO Candy. It took off because institutions saw that and bought the stock. It went to 40 in a blink, 3 days. I didn't expect that. Only God knows that was going to happen. But I knew that with the stock at 23, 24, if the stock is worth closer to 40 than 20, then I was risking 23. I'm risking $3 against the possibility of getting 17. 17 to 3, that's 6 to 1 odds in your favor on a coin flip. And we got, boom, winner, winner, chicken dinner. And now it's back to right in between. It's sitting smack dab in the middle of 20 to 40. That's all I know. You now know as much as I do. Go to IPO Candy for the rest. We are not talking about AVEX anymore on this show. Boom, done. We're done. Not this week, not next week at all, period. I don't know the company. It's a multi-billion-dollar market cap. I'm looking at companies below 500 million ideally, because those are the ones that triple, quadruple, go up 10x the easiest. You look at Air, right? Nobody knew who Air was when I told you to buy it at 3. Now it's up 10x in a year to 3 billion. This company had a market cap under 300 million. See? Under 500 million is a sweet spot. I even like it better if it's under 100 million. The smaller the company, the easier it is for it to multiply in valuation. You look at Watt, 153 million, but $7 of cash. You feel me? $7 of cash. So you're only paying 113 million for the equity. The rest, the other 40 million's in cash. This makes it easy for a valuation to multiply. What else we got here? Hey Mark, could you do us a favor and pull up your VTSI DCF model? No, I'm not doing that. I don't do that on command. Okay, those are my proprietary things, and I share them on command. The only thing I show are charts. Okay, it's a fair question, but no. I'm down. GKPRF, please review holding. I don't know what that means. Is VTSI a speculative wait time stock to trim in a yellow alert, or should I buy more given the risk reward? I mean, that's a fair question. You should know already, okay, because VTSI is a gold mine stock. They will always be a gold mine stock. They've been a gold mine stock as long as I've been covering them, which goes back before 2020. This is just a good company. Look, over the years, it's a weird chart, but there we go. Right? There's a chart going back over 15 years of the stock. Steady Eddie, 14% CAGR, CAGR, look it up, on this fundamental lines, which actually match the technical lines. You got multiple tops, multiple bottoms. So the gray lines would be the same as the red-green lines. It just so happens that they're in a rough patch right now, but it's still a gold mine stock. It's a proven company, a company that's proven to be profitable, proven to have a product that is wanted and needed in the marketplace. They're just going through a rough patch right now. And as soon as that rough patch is over, like we had a government shutdown, budgets are just now coming back, all that stuff, once that funding comes back, that pent-up demand should help the business. Should. And if it does, the stock should go higher. Thoughts on the quantum industry after Nvidia announced co-op with error correction? Can't get into that today. And in fact, the right answer is I don't know. For Curie, how do you think about the trade-off between near-term free cash flow and investing in AI licensing? Yeah, I mean, we can't get into that. That's part of methodology. I can't teach you my method of investing. It took me 10 years full time, literally. From the time I woke up to the time I went to bed for 10 years. I was either at work learning about stocks or at home learning about stocks. I can't teach that here. I can teach you how to play the stocks that I find using that method. Let's see. As INVE makes the tags and watt powers for Wiliot, why wouldn't its growth mirror Watt's? So the growth of their tags, now it's really different, right? Because Wiliot's boxes can power multiple tags, so the growth can be different. Although, yes, there should be some similarities, right? Up and to the right is up and to the right. But that's just one customer of INVE. And INVE needs multiple customers to become profitable, okay? I see Watt on a path to profitability based on the customers they have right now. And that's the big difference. So when I do the math on both of them, I was more positive on WATT. And we're going back into methodology. You could ask me why, and then I would have to walk you through the whole analysis. And we're talking about over 100 hours of research to get to these conclusions. All right. So, I mean, I wish I could teach you guys all that, but I can't. I can just point you in certain directions. You go out on the internet and learn how to value stocks, learn about a DCF analysis, learn about independent third-party industry experts, which to me is the number one thing that you need to have confidence in a pick. Independent third-party industry experts. Nobody has ever told you that. I will bet you that nobody has ever told you that that is the number one thing. And yet 99.9% of stocks that you will hear about from people do not have that number one thing attached to it. That's how you know that you are possibly dealing with a clown. Because they don't know that that's the most important thing, and they did not take that step. And therefore, they do not have this kind of track record. It's easy when you do it right. And if you don't, you're probably a clown, because it's not that hard to do right. We're in the age of AI, ladies and gentlemen. You can find independent third-party industry experts on the internet just by asking AI to find one for you. And if they can't, then on to the next. Next stock, next stock, next stock. I'm looking for a stock where I can find that expert to validate the technology. I want to know that I'm dealing with the best of the best at a time where people don't know that their sales are about to inflect. So I can buy the stock before everybody else finds out. And when they do, the stock takes off. Because one, it's already undervalued. And two, now everybody's finding out about it. It's easy. It's easy. Are those lines on track white or gray? They're kind of both. Right? They're definitely gray, but they're also kind of white. They're both, really. So I'm leaving them white. Yeah, I mean, this is my impression of, like, I don't think the stock should go any lower. Okay? And that's where you see this. Yeah, we got to keep moving because we're already going to go overtime. Lightning round. It's both. Let's call them white. Okay? But in this case, it works both ways. TPCS, I understand new subs are bullish because Raynor is very profitable, but more business for Stadco, is that even a good thing right now? Yes, it's fine. More business is good. It's just a matter of whether management can handle it properly. TPCS is worth a ton more as a registered supplier, isn't it? I don't know. I think it's worth plenty right now. They are the only supplier for certain parts into those programs. Period. Yeah, I don't think you need anything else. CTLP buyout still not approved, and the upside is a max of 6%. So would it make more sense to put money in a gold mine stock instead of waiting? No, because I got a ton of cash sitting on the sidelines. So I have a position, right? I have made a bet on the CTLP acquisition going through, namely through owning CTLPP. I also told you that I have hedged by having also a side position that's CTLPP with a short on CTLP. I don't want to confuse people, but there's a reason for that too. But I am bullish on the acquisition going through, and because I have cash sitting on the sidelines, which you should too. I have a ton of cash sitting on the sideline because it's hard to find cheap stocks right now. Did you not hear what I said at the beginning of this broadcast? How is it possible that you do not have cash sitting on the sidelines for CTLP with the market at these levels? That's crazy to me. I have never had more cash sitting on the sidelines than I do right now because of where the market is right now. And yes, I own a ton of what? I own a ton of these names I've been telling you about. These are great companies, but I'm not going to spend all my money on them. I'm going to follow my rules and limit how much money I put into each stock. Right? I've got my 10% max. And if I can't find enough stocks to use all my cash, that's God telling me don't. Bro, you should know this by now. Can you pull up the CrowdStrike chart? I'm not playing with CrowdStrike right now. I love the company, but there's too much uncertainty going on. And this is the thing, man. Like, when you are dealing with mega cap stocks, you're competing against the Wharton and Harvard MBAs on Wall Street that are also looking at it. Okay, so you got to have some kind of advantage, and I don't right now. I don't feel comfortable that I have an advantage over those guys in CrowdStrike. And at a time where the market is at all-time highs and that greed is almost at the red line, that's where I want to get rid of stuff. I like Nvidia more than CrowdStrike, and you just saw me sell Nvidia on this live. 4 o'clock, we're out of here. Last two questions, really quick. INVE IFCO deal, that can 2 to 3x their revenue. Isn't that enough to get them out of cash burn in 2027? Yeah, maybe, bro, but here's the thing. And then what? Right? You need more customers to keep a steady flow of cash, because the way these deals work for INVE is that there's a massive initial sell into the customer, right? Tons of tags. And then once the customer has enough tags, you're only selling more tags as the customer grows, and these giant customers don't grow fast, 1. And 2, as tags need to be replaced, which also doesn't happen fast. So you can have a situation where you get, let's say, a $3 million deal, and you fulfill it over 3 years, 1 million, 1 million, 1 million. And then after that, the demand might be 100,000 for growth and 100,000 for replacement. That's only 200,000. You just went from 1 million, 1 million, 1 million down to 200,000. Your revenue collapsed. If you don't have a new customer to pick up the slack, then you're in trouble. That's customer concentration risk. That's where you see WATT losing that customer concentration risk by moving from Walmart alone to Walmart and Amazon to British Tobacco to 20 AWS POCs going on. Right? You need to see the customer concentration risk drop. You can't just enter profitability. You have to stay there. ITM is the intermap chart. Specifically the US version of the chart you asked for. And that's it. That was the last question of the day. By the way, great move here, right? We had great information coming from our community. Thank you, gentlemen, who supplied information that got us into Intermap in the $1 range before it popped to $1.50. We're waiting for that Indonesian contract to come through. The optimism from the information you supplied us with gave us a nice 50% gain, but now we're at the 200-day moving average. We've got some resistance here, and we got to see the proof in the pudding. Okay, when you make 50% in such a short period of time, what was that? 1.2 months, about 6 weeks. 50%, right? We got 50%. We got 200-day moving average. We got my wife at the door. We got my baby at the door. I'm going to go spend time with my family. Come back for next Friday with Money Mark on Stock Talk Live. We'll catch you next week. What is it? Kiki, is it you, baby? Hi, baby. Hi, baby. Come here.